Remember, we said that the sum of a geometric progression is the one formula that rules them all, tying together annuities, perpetuities, and discounted cash flows? Well, today we're deep diving into that same formula, but focused more on equity analysis. We'll see how equity valuation models, from PE ratios to dividend discount models, are really just elegant variations of that same geometric idea. Now let's start with something simple, more of a review of last time for those new to the channel. Well, the price of the stock today, P sub 0, can be thought of as the present value of all future cash flows, usually dividends. And we have this formula over here. And if dividends grow at a constant rate G, we showed last time that this simplifies to this formula, P sub 0 is equal to D sub 1 over R minus G. And that's the Gordon growth model for dividend paying stocks with a constant growth G of the dividend payouts. R is the discount rate, and D1 being the expected dividend computed at last year's dividend times 1 plus G. Now, here's the thing. Most investors don't really look directly at dividends per se. They look at earnings first. So we connect dividends to earnings through the payout ratio B. So D sub 1 can be thought of as B, the payout ratio, times the E1, the earnings per share. This means B is the percentage of expected earnings that will be paid out in dividends, where again, E is the earnings per share. So substituting into the dividend discount model, P sub 0 is therefore equal to B times E1 all over R minus G. And dividing both sides by E sub 1, we have P sub 0 all over E sub 1 is equal to B all over R minus G. Now, this is the PE ratio, grounded in the same geometric progression logic. Okay, so now let's connect growth G to show how a company performs. If a company pays out B in dividends from earnings, then it retains 1 minus B of its earnings as reinvestment within the company to continue growing the company. Therefore, earnings are very important. It's the basis of all that the company can pay out in dividends B, or to be retained internally 1 minus B, to grow the company, and which grows as well the future dividends. So we have this formulas. ROE is really nothing more but net income all over shareholders' equity. B is the payout ratio, how much of the ROE is paid out in dividends. And G is equal to ROE times 1 minus B, or the sustainable growth rate. So the higher ROE implies higher stock prices, as it is the basis for growth in either dividend payouts B or future reinvestments in the company to consistently grow dividends by G. So a quick discussion on ROE analysis is in order through the DuPont model. Don't worry, this is actually quite easy. We can think of ROE as profit margin times asset turnover times financial leverage. In terms of the ratios, ROE is equal to net income over sales times sales over assets times assets over equity. Now notice how the terms just cancel each other out, leaving us with ROE to equity as originally stated. But this way, you can take a look at how a company performs and generates ROE. Is it coming from higher profit margins, meaning higher net income relative to the sales? Is it coming from very high sales, expressed as a percentage of the total assets? Or is it because the company has high borrowings? There might be too much debt, which is funding the assets, but that also increases the ROE because of a low base in terms of the equity, funding all of the sales and funding all of the assets. So higher ROE can be achieved via higher profit margins coming from higher net income from sales generated, and higher sales means higher ROE, and those sales are generated by the assets a company has. And higher leverage means higher ROE, meaning a small equity relative to the assets needed to generate high sales will generate higher return on equity. But the logic is clear. Better operations translate to profitability, translate to more earnings, improve dividends, and improve growth, and it will all impact the price positively. It's all linked by the same geometric logic. That's how you can analyze the ROE of a company and how it is giving returns. Putting all together. Now, summarizing, we can write P all over E, the price to earnings, is equal to B all over R minus ROE times 1 minus B. So you might say to yourself, here B should be maximized to have a higher numerator, right? And it will improve the stock price or the PE ratios. But is this a correct assessment? It can be seen from this formula. The higher the B, the numerator does indeed become higher, which should give a higher stock price or a higher PE ratio. However, let's also take a look at what happens to the denominator when B becomes higher. Ideally, the smaller the denominator or the divider, the higher the ratio. So if you divide the pie by 4 instead of 2, the slices become smaller. So if you want a smaller divider or denominator to get higher ratios, what you need is to have a smaller number of cuts to have bigger slices. So for the denominator here, the bigger the number you can subtract from R, the smaller the denominator and the higher the overall ratio. This happens when you subtract the entire ROE from R, which implies that B must be 0 for this to happen. But if B is equal to 0, that means no dividends will be paid out. So the logic of, let's give high dividends as much as possible, that doesn't really compute, given that it slows down growth of ROE and therefore lowers future dividends. So there's a balance between B and its impact to dividend growth G. You want B to be big enough, but not too big that it hurts dividend growth G equals ROE times 1 minus B. Said another way, you want B to be small enough so that you can maximize growth, but it has to be big enough so that the numerator, the pie being divided, is still big enough. So ultimately, what's important is really high ROE, is what makes sense, because it amplifies benefits without messing around with B or G. So it's like having a bigger pie rather than how the pie is sliced. You also have to note that if you have a high discount rate, it lowers the valuation because you're going to have a higher divisor. So it's going to lower the valuation. But this is more a function of market forces rather than anything that's within the power of a company per se. So overall, the PE ratio reflects how R, P, and ROE balance. The same geometric series that helps us value perpetuities also governs stock valuations. That's the takeaway. With dividends, you have cash flows, earnings feed dividends, ROE drives growth, and R discounts it all back. So one formula, and you have so many applications. The one ring truly rules them all. Quick takeaway on the PE ratio and how to use them in real life. Well, for evaluation comparisons, one has to compare the PE ratio of a stock to its historical PE or its industry peers or some relevant benchmark index. This helps identify whether the stock is undervalued or fairly valued or overvalued relative to its past or its competitors or to a benchmark. A much higher PE ratio than peers might indicate overvaluation, while a lower PE could suggest undervaluation or potential issues. By itself, PE is meaningless and only has meaning through context. So it's really a relative valuation method to determine how much one is willing to pay for the stock relative to the earning per share. For example, a PE of 25 means you pay $25 for each buck that the company earns. Now, is that too much? Is it too little? That cannot be answered in a vacuum and needs further context. In our next video, we'll learn how to estimate growth and discount rates and why PE ratios can fool you when assumptions are off. If you found this useful, like and subscribe, and remember, math isn't just numbers, it's the structure of value itself. See you next time!